Enphase Energy specializes in solar energy technology. They develop microinverters that convert solar panel output to usable electricity more efficiently. Additionally, they provide monitoring and control solutions for solar systems, helping users track performance and maximize energy usage. Enphase also offers energy management products like storage systems to store excess solar energy for later use. Enphase had a very rough year so far, with the stock falling more than 50%. But if you look at the longer time frame, we can see that the stock has absolutely crushed it. If you had bought Enphase 5 years ago, you would have seen your investment grow 24-fold. That is incredible. But let's move over to QuantView, our stock insight tool, to get a broader insight into how Enphase is performing. And as we can see here, the revenue has been in an amazing uptrend in recent years. What is great to see is that they also have been able to turn their revenue into free cash flows, showing great growth in those areas too. To sustain growth, they have been diluting shareholders by a little bit, which is not a huge problem. Their debt position has absolutely exploded in 2021, which would be concerning if Enphase was still unprofitable. But this is not the case, which is reflected in the debt to EBITDA, which moved very nicely under our preferred 3.5 times ceiling. Another green flag about Enphase is their insider ownership. Insiders own over 3.5% of the outstanding shares, which means they have a good amount of skin in the game. And what's even better is that they have also been buying, increasing their stake by almost 2%. Institutions have also been loading up on Enphase, increasing their stake by over 8%. These are all very good signs showing faith in the company's future. And by the way, if you want to get access to the stock insight tool and all of the valuation models that we will be using in this video, be sure to check out my Patreon link in the description, where you can get your hands on a bunch of spreadsheets to enhance your investing journey. And with that out of the way, in today's video we will be taking a 3-step approach to thoroughly evaluate Enphase and determine its fair value. Step 1. Margin of safety. In this step, we'll assess Enphase's key metrics and ratios to determine if we should be more or less cautious when determining a fair value. Here, we'll delve into Enphase's financial statements and assess critical metrics and ratios. In step 3, we will be using a combination of valuation models such as discounted cash flow and Graham's valuation to gain an insight into the value of the business. This step allows us to understand whether the stock is overvalued or undervalued in the current market based on different metrics. And in conclusion, by combining the findings from the 3 steps, we'll ultimately determine the fair value of Enphase as an investment opportunity. To determine this final valuation, we'll be using a margin of safety. This margin of safety will be based on the financial ratios, the financial health and the growth of the company. It will be using a standard margin of safety of 20% that can never go below 0%. The margin of safety can either increase or decrease based on the ratios that we'll be looking at in just a moment. And the severity that the margin of safety will increase or decrease by will be determined by using a scale. When we're using 4 colors in a scale, bright red will mean a 5% increase, orange will mean no change, light green will mean a 5% deduction, and bright green will mean a 10% deduction from a margin of safety. When we are using 3 colors, bright red will mean a 5% increase, orange will mean no change, and bright green will mean a 5% deduction. First metrics that we'll be looking at are the margin and EBIT growth. As we can see, the EBIT has gone up over the years, going from $105 million in 2019 to over $400 million in 2022. The average EBIT growth during this period has been sitting at 67%, which is way past the bright green part of our scale, indicating a 10% deduction in the margin of safety. If you then look at the margin, it has also increased, going from just under 17% to over 19% in 2022. The average margin growth during this period has been sitting at more than 10%, which is also in the bright green part of a scale, indicating another 5% deduction in the margin of safety. And the final 2 metrics that we'll be looking at are the debt to EBITDA and return on invested capital. To get a debt to EBITDA ratio, we have to take the debt of the company, subtract the cash from it, and divide it by the EBITDA. Out of this, we get the amount of years of EBITDA it takes for the company to pay off all of their debt. And as we can see in the graph, their cash position is currently greater than their debt position, meaning that they can pay off all of their debt just using their cash. This indicates a 0% debt to EBITDA ratio, which is in the green part of a scale once again, indicating a 5% deduction in the margin of safety. The return on invested capital for Enphase is also sitting at a very nice 53%, indicating that the management is very effective at allocating capital, and this awards them with yet another 5% deduction in the margin of safety. Looking very good so far for Enphase, but let's go look at the valuation models next to determine the intrinsic value of the company. The first valuation model that we'll be using is the discounted cash flow model. I've imported free cash flow of Enphase going from 2019 to 2022. The average growth rate and the annual free cash flow during this period has been sitting at over 80%, and I'm projecting their future free cash flow to grow by 14% annually. And this percentage will be used to determine the future free cash flow for Enphase and determine a terminal year of valuation, using a perpetual growth rate of 3% and a discount rate of 10%. And this gives us a sum of free cash flow of over $20 billion. And to get to our equity value, we have to add the cash and equivalents and subtract the debt, giving us an equity value of $20.7 billion. And dividing this by the amount of shares outstanding, we get a discounted cash flow price per share of $152.11, which is an upside of almost 30%. The second model we'll be using is Graham's revised valuation formula. In this model, we take a look at the earnings per share that Enphase is generating, the growth rate estimate projected by Wall Street, and the current yield of AAA corporate bonds in relation to the average yield of AAA corporate bonds that is always sitting at 4.4. And we go by the theory of Benjamin Graham that a PE of a company with no growth should never exceed 7. And looking at all of these metrics, we get a Graham's price per share of $114.41, which is a downside of just over 2%. The next model we'll be using is the multiple valuation. In this model, we take a look at similar companies to Enphase, look at their stock price and their earnings per share. This way, we can determine the average PE multiple in the industry, which in this case is sitting at 39.82. And to get to our intrinsic value, we only have to multiply by the earnings per share that Enphase is generating, which is $3.93 a share, giving us an intrinsic value of this model of $156.50, which is an upside of over 33%. And the last model we'll be using is the mean reversion theory. In this model, we go by the theory that a company will always trade above or below its mean, and the metric that we use to determine this is the PE ratio. In this case, I've imported the PE ratio of the past 5 years, and on average it has been sitting at just over 55, while the current PE ratio is sitting at only 29.62, indicating that's undervalued on this metric, giving us an intrinsic value of this model of $217.47, which is an upside of almost 86%. Now that we've gone through all of our valuation models, let's go look at the final overview of our valuation next. Coming to our final overview, we've imported the discounted cash flow, Graham's valuation, the multiple valuation, and the mean reversion theory price per share, giving us an average of $160.14. A margin of safety we've determined earlier, using a standard margin of safety of 20%, and deducting it by 10% for the EBIT growth and 5% for the margin growth, debt to EBITDA, and return on invested capital, leaving us with no margin of safety at all. Meaning that the average price per share out of our models is the fair value that we've determined. And then with the current price of $117.06, we get an upside of almost 37%, indicating that at the current prices, it is, by our valuation, a buy. And if you want to get access to the stock valuation models that we used in this video and our stock insight tool, you can check the description for our Patreon link. This would support me greatly. And if there's any other companies that you would like to see me cover on this channel, please let me know as well. And thanks for watching.